Anna Mwasha, Mr. Shikanabo, good afternoon.
Good afternoon.
My name is Ami Julian. Our dear listeners and investors and clients, it's another day where we are graced by CRDB's presence, especially Madam Anna Mwasha, who's the head of investor relations. I think she will introduce herself, and Mr. Frederick Shikanabo, the CFO himself. My name is Ami Julian, once again from Orbit Securities. I am with Mr. Fortius Rutabingwa, who's the head of research over here. What brings us here today is specifically CRDB's impressive financial performance in the year 2023. We know that numbers say something, but the whole point we are together is just to have the feel. What is the story behind the numbers? On the market, we have seen the share prices moved from 460 and now it hovers around 510 Tanzanian shillings per share. The metrics are well. So I think let me take this time just to bring in all the speakers today, starting with our side in Orbit Securities, Mr. Fortius Rutabingwa. Karibu sana mkuu.
Okay, Mr. Ami, thank you very much for moderating this session. My name is Fortius Rutabingwa, Head of Research, Orbit Securities. I'm welcoming you all to participate in this event, and I'm grateful for CRDB to grace us as their time for them to share the story about behind these numbers. So please welcome, stay attentive and ask questions because we have the people behind the numbers.
It's a true pleasure to be here and share our 2023 numbers, as well as
Anna Mwasha.
Okay, all right, sorry about that. And just to take you through our numbers and the story behind the numbers, as Ami introduced, I am responsible for investor relations, so really explaining and giving you confidence in the numbers. And with me is Mr. Frederick Shikanabo, our CFO, and we also have other members of the team, the CRDB team. We have Mr. Kenneth Mkama, who looks after subsidiaries. So without further ado, I would welcome Fred, and I think he would maybe use about 20 minutes to go through the presentation, and then we'll spend the rest of the time taking questions and providing any clarity that might be required. Fred, karibu sana.
Thank you, and thank you, Orbit, Ami, and for organizing this call, and really thanks everyone for joining. We are glad to share our full year results, which I will cover.
Please stop the video.
Okay, first was our first year for our 5 years strategy, 2023 to 2027. And our strategic purpose is improve livelihood and deliver sustainable impact. We aspire to be the largest and indisputable leading bank in the market. We focus on 3 strategic pillars: fortifying our core business, accelerating our growth, and invest in innovation for the future. Our strategic initiative that we set out last year, and we started the implementation. I'm glad to share the results for the first year. We closed the year with a profit after tax of 424 billion, which is 21% year-to-year growth, just backed up with the balance sheet growth of 14% to 13.29 trillion. And this is the largest balance sheet in the market. Our cost-to-income ratio closed at 49.5, compared to 49.4 in 2022. Our NPL remained at the same level as it was last year, 2.8. Return on equity improved to 26.7 compared to 26%. We maintained a strong capital base, 16.1 compared to 17 compared to 17% in the previous year. This is reflecting from what you see in the stocks in the market. We have recorded a 16% increase in terms of the performance in our share price in the market. And that is actually in the back of the confidence from the market on the performance. Just to inform on our dividend payout ratio, the policy, we pay 35% of the net profit, and that actually gives the outlook in terms of the dividend payout on the current year performance. The key milestone that we recorded in 2023, which is in line with our strategic pillar, we continue to focus in our customer, making sure we are able to serve better and improve the customer experience. We embarked on a new program which focused on making sure that we build up a teamwork to support better our customer. We also embarked on cultural transformation program during the year. We focused on operational efficiency, strengthening and improving our processes. We also continue to invest in technology to make sure we are able to improve our process and deploy the cost to save more. In terms of accelerating the business growth, we focused on the new market. We launched the new product, including the insurance product. We launched the cross-border investment, including our new market to the Congo, as I highlighted. We launched the new solutions into the market in terms of the digital solutions, but we also added to the market penetration in terms of the inclusive finance initiative and reaching out the areas that have been financially excluded, leveraging on our technology. In terms of innovating for tomorrow, we continued to focus on our sustainable action through our subsidiary, our CRDB Foundation subsidiary. We continue to forge the partnership to address the financial inclusion and integrate more sustainability into our overall business activities. We are able to sign up a couple of partnerships, including the UNDP, just focusing on the youth and the women. We continued to scale up our digital transformation, forging the collaboration with the fintechs and just strengthening our cyber security investments. We also continue on our workforce investment, diversified the financial, diversified the well-diversified workforce in terms of well-diversified workforce in terms of gender and the diversity, and we the GDP closing at 5.3 as we are closing the year, and we continue to see supportive environment from the regulator and the overall government initiative. In terms of the inflation, we closed with the inflation. That is in the East African market compared to the neighboring countries, Kenya, Uganda, and Burundi and the Congo, the two markets we also operate. So M3, as we close the year, you note, closed at 14.1, and the credit expansion to the public closed at around 17. Just to highlight in terms of other markets that we are operating in, inflation in Congo closed at 23.7, while inflation in Burundi closed at around 20%. Just to compare ourselves to the industry, you note the MPL for the industry closed at 4.3. We closed at 2.8. The return on equity closed at 13.03. We closed at 26.7. The return on asset closed at 2.1. We closed at 4.8. Our NIM was at 7.8, and I will just explain more on the next slide. But the overall industry NIM was at around 6.4. Cost to income ratio for the overall industry was at 50.8. We closed at 49.5. So in terms of the financial highlight, again, as I highlighted, we closed with a strong performance with a total asset growth of 14%, closing with a 13.26 trillion balance sheet, backed up mainly with the growth in the loan portfolio, growing at around 23% to close with 8.45 trillion, mainly a growth recorded on corporate and the MSCs. This is on the back of the growth on the deposits that grew by 8%, mainly due to the liquidity trend in the market, but supported balance sheet supported with the growth in the borrowing, which grew by 20% to 1.78 trillion as we are closing the year. And this will explain what you will see actually in our funding cost. So in terms of our portfolio, the portfolio split as we closed the year remained more or less at the same level we had in 2022, 46% in corporate, same as in 2022, and 35% in consumer lending, personal lending. SME at 12%, and that's a slight increase, and it explains our strategic focus. I have highlighted we started implementation in 2023, where we are focusing mainly on retail segment, particularly on SME and the MSCs. So micro remained at 2%, and the other sectors remained at 5% as it was in the previous year. In terms of the overall FX exposure to the total portfolio stood at 27%. And remember when we shared our results in half year, this was around 30%. And then we highlighted on our strategic focus to make sure we are able to bring down our portfolio exposure on Forex. This is in line with what we see as the trend on the Forex, the foreign currency challenges in the market. The overall NPL closed at 2.8, and not more or less the same as we closed last year. Mainly covered over the various sectors we see in the next slide. Our NPL coverage closed at 51%, as we are explaining in half year. This is mainly contributed by one of the slipping NPL from one of the corporate customer in agriculture, which has strong collateral despite of slipping in the non-performing loans. We continue to monitor the performance of this customer. We are confident we should be able to see a recovery, recovering in terms of his performance. In terms of the NPL split, as I have highlighted, you see the corporate has got the highest NPL, and that's mainly explained by what I have highlighted. One of the biggest corporate customer in agriculture is actually contributing to this sector, to this NPL. Again, SMEs, consumer lending, and other just have a small contribution in the segment. And in terms of the sector, you see again agriculture coming in, consumer lending, but this is mainly on the basis also of the portfolio exposure that we have in these sectors. So in terms of deposit mix, the biggest funding is coming from a deposit. Around 69% as we close the year is funded from deposit. 14% is funded by equity, and the 17% is funded from borrowing. As I highlighted during the year, our borrowing grew just due to the liquid rate, actually this expenditure on the government side. We noted liquidity squeeze in the market as we are closing the year, and that is reflecting in terms of what we see. But again, as you noted on the balance sheet growth, our loan portfolio grew, mainly explained as we shared in the previous half-year results, mainly coming from the investments, one relating to the catch-up growth post-COVID trend. A lot of investments are trying to complete, a lot of investors and the business are trying to complete the projects that were delayed during COVID. And we see a lot of demand in terms of credit to the private sector. And we believe, as you note, from the year-to-year growth compared to what we saw in 2022, there is a bit smoothening in terms of the growth, just because of that the post-COVID trend in terms of the investment catch-up. So in terms of the deposit per segment, again, as we close the year, 61% of our deposit coming from retail, while 39% is coming from corporate. We continued to maintain a strong capital base. As we closed the year, we closed with our capital at 17.4 in terms of the total capital, and 16.1 in terms of the Tier 1 capital. Just to share the development in the market, during the year, the central bank issued a regulation in terms of the implementation of Basel II, Basel III. And that's actually banks will start with the a parallel reporting in terms of the capital, starting from April this year. And it will become mandatory for the bank to comply starting from April 2025. The central bank will continue to monitor and engage the banks in terms of the adoption. But so far, the simulation we have done, we continue to maintain a strong capital with the implementation of Basel II, Basel III coming 2025. In terms of the profit highlight, as I highlighted, we closed with a strong performance, 21% in terms of the profit after tax, closing with a PAT of 424 billion, mainly contributed by the growth in the interest income, which grew by 29%, mainly on the back of the growth in the loan portfolio. But as I highlighted, and I will share in the next slide, as we are starting the year, we noted our NIM just being depressed by the rising interest rates in the market. And we had to go back on the reprice in line with the trends that we are seeing in the market. And as you note in the next slide, our NIM improved on quarter to quarter as we engaged the customer to reprice our portfolio. Interest expense grew by 58% in line with the growing interest rates in the market, and in line with what was happening in the global market in relation to the interest rates. So our net interest income grew by 19%. Non-funded income grew by 11%, and as we had shared during the half year, the non-funded income growth mainly was coming from the digital channel. And however, we noted a suppressed income in terms of the available for sale income, as we see in the next slide, due to the increasing interest rates on the government security in the market. So our operating cost grew by 16% on the back of the strategic initiative we took during the year, mainly on our subsidiary expansion. We started operation in our Congo subsidiary. We opened two subsidiaries, the CRDB Foundation and the CRDB Insurance subsidiary, just actually explaining the growth in our operating expenditure, also contributed by the business growth. So I just briefly talked about this. You could see the NIM evolution during the quarter. As we embarked on repricing our loan portfolio, you could see our NIM from Q1 grew from 7.4 to 8.3 as we are closing the Q4 2023. And we continue to focus on aligning our portfolio pricing in line with the market trend, and making sure we align our portfolio mix. As I highlighted, our strategic focus is growing more on retail, particularly the SME and the MSCs, to make sure that we are able to diversify our investments and address the suppressed NIM from the funding cost. So non-interest income, as highlighted, mainly contributed by alternative channel. You note 23% growth in fees and commission, and as you could see, SIM banking and agents banking mainly contributing the significant figure. Our forex income grew by 19%, despite of the challenges in terms of the forex in the market. Other operating income that is explained by what I highlighted on available for sale income, just affected by the government security interest rates trend in the market. So in terms of operating cost, I think I have explained about this. Again, our cost to income ratio closed at 49.5 compared to 49.4 on the back of our business operation and expansion strategy. Just a highlight on our subsidiary performance. Burundi subsidiary continue to contribute positively to the group, closing with a profit after tax of 30.2 billion, a growth of 31%. Congo subsidiary closed with a loss of 4.6. Note that Congo operated half year, and we are glad to report that it is now in full operation. We see a positive trend, and we are confident we should be able to see a break even in line with our targets. Insurance subsidiary started the operation again half year. As we highlighted half year, we obtained the license in Q2, and we should see it again breaking even in line with our plan. CRDB Foundation, this is a non-profit, mainly focusing on the financial inclusion on women and the youth. We have seen during the year a couple of engagements and forging the strategic partnership to address financial inclusion, particularly our flagship product during the year in Beju. Actually, we're able to reach a number of groups and a number of startups, and we have been able to see a couple of partnership and more of attraction to the segment that had actually not been touched in terms of the women and the youth and the startups. So I would stop here and invite some inviting questions, and then we take the last part, which is the outlooks.
Thank you, Mr. Shikanabo, for quite a good, impressive presentations. The numbers are quite impressive. And without further ado, I think I'll bring in Mr. Fortius for his comments and if he has a few questions under his belt.
Okay, thank you, Ami. I think you can hear me. Am I visible? Okay.
Not really.
Shekanabo, you know my color is scarce, so even in this kind of gadgets, just see my teeth. It's just okay. Thank you very much, Fred, for your presentation. And of course, I was especially interested on that segment of loan composition where SME is now increasing from 10% last year to 12%. And I hope it will continue to increase because that is the most significant sector which need a lot of financing from the banking sector. Now, quickly, I have some few questions. Maybe another question you will respond to it when you will be presenting the outlook. But my question is based on especially on the interest rate environment. As you are aware, we have started the implementation of monetary policy with interest rate targeting. Now, with this kind of environment, how do you see the NIM behaving? Because now interest rate will be the focus of many participants in the economy. How do you see the outlook for interest rate? My second question is on your outlook for the loan and deposit growth. Because the loan to deposit ratio, which you have just reported, is much on the high side. So I'd like to hear your view on the outlook for loans deposit and deposit growth, and especially on the way you are going to address the potential liquidity risk given these ratios.
Thank you, Fortius. Just to start with the last one. On the loan portfolio, the loan to deposit growth. As I highlighted, the loan to deposit growth, you note from the micros, the credit expansion to the public sectors is expanding at a higher rate compared to credit expansion to the M3. And you could see even the market trend is moving in a different direction. As you note, last year we are growing at 22. We grew the credit expansion in the market to private sector 22.5%. This year it's around 17%. And I highlighted on two things. One, the catch-up, post-COVID catch-up, but the expansion in terms of the economic activities due to the government initiative to support the business growth, the microeconomic environment, and the policy, supportive policy to the business. So we see a lot of attraction in terms of the business and a lot of economic activities being activated. A couple of projects coming to actually, most of these were capital expenditure financing. As you understand, the market still has a challenge in terms of the funding gap, more available funding. So now that that being, you see from the market, then banks going for the alternative funding, that's the borrowing. And you see not from our balance sheet, but the overall market balance sheet, we see more of the expansion of the borrowing. One, from the market liquidity trend, but two, from the funding requirement in the back of what we see on the M3 expansion. So that also answers the loan to deposit ratio. Half year, we saw contraction in terms of the government spending. So liquidity was a bit squeezed. So more of the borrowing compared to more of the deposit that could be mobilized from the public to fund the balance sheet. But however, as you move forward, as you asked, we see a deposit growth at around 15 to 25% going forward. And that is actually will cover the gap. The deposit growth takes longer to unfold, particularly if you are raising the deposit from the retail market. And as you noted from our funding portfolio on the deposit, more of the deposits are mainly focused to be coming from the retail segment, which takes more time to grow. However, again, our corporate portfolio continue to contribute a good percentage in terms of our funding funding source. So we foresee our loan to deposit ratio to set at around 75%, but that will be gradual over time.
Thanks,
So,
Mr. Chikana.
You saw a couple of revisions of interest rates from the Fed. So the same we have seen in terms of the central bank, the T-bill and the T-bonds rates on the increasing trend. That actually reflects what we have shared as the increase in the interest rates, interest expense in our P&L. We foresee this to continue during the year, as we have seen from the trends on the previous auction. We see more of interest rates going up. The last auction, as you could see, the T-bills and the T-bonds rates were on the increasing trend. We closed at around 11.4 for the 1 year T-bill. And for the bond, in January, we closed at 12.25, indicating likelihood of more appetite or from the central bank to mop up the liquidity from the market. But we believe we continue to align in terms of our portfolio mix and the repricing of our portfolio to make sure that it doesn't affect our NIM.
Thank you very much, Mr. Fred and Shekanabo. Maybe another question, briefly, if you can share with us on the foreign exchange market, what do you foresee in the market? How are you positioned to withstand the potential foreign exchange risk in the market at the moment?
Okay, I'll just briefly talk about, but I'll just also invite in my colleague Barton to talk about that. But as I highlighted, when I was presenting our portfolio mix, as we were sharing the half-year results, we highlighted on this, and we also highlighted on our strategic initiative to make sure that we cushion ourselves in whatever movement in the foreign exchange on our forex loan portfolio exposure. As we're closing the year, our portfolio exposure closed at 24%, as I highlighted in the presentation of the total portfolio, compared to 30% we had shared during the half year. And we highlighted this continued to decrease because these are temporary exposure, mainly on seasonal crops. So we believe that would continue to ease and decrease, and we continue to monitor and make sure we are able to contain the portfolio exposure ahead of whatever can be the foreign exchange dynamics in the market. So, Barton?
Yes, thank you, Chief. I hope everyone can hear me.
Yes, we can.
Thank you very much. I think CFO is spot on in terms of the trajectory on the foreign exchange. We anticipate an improved condition on the back of the foreign exchange reserve, which is sufficient for import cover of up to more than 4 months. This is a moderate and enough reserve to sustain the country. And I think even if we compare with the other East African countries, we are better off. But also, he spoke a lot about seasonality in terms of the inflow. We have been seeing an increased number of tourists that we expect to beef up our foreign exchange position because traditionally we have been getting $2 billion annually, but I think there's an improved size to $2.5 billion. But also, as Tanzania is diversified sector in terms of economic sectors, also we are banking on that. Given that our geographical position, we are still the other landlocked country are relying on most of the things that are coming via some ports. And as such, also we're getting good inflow from the logistics business. And therefore, the market condition are going to really improve as we go along, given the things that we're working together, the projects that are supporting us. They will start to use the foreign exchange. So I'm very confident that the foreign exchange market condition will improve. Thanks.
Thank you. Thank you. Barton, back to you, Fortis.
Thank you. Just a moment. Okay, maybe before you go to the outlook, first of all, thank you for your clarification on the questions you have asked. Now, another question is general on the competitive landscape, given your competitor nowadays, not only from the banks, but I can say the technology. How are you positioning yourself to weather this competitive storm going forward?
Thank you for this. As you clearly point out, the competitive landscape continue to be challenging and dynamic. Actually, some of the players that we are not actually competitors are now coming into play. We have been actually in competition with the financial institution, commercial banks, so to say. But now we see more of the mobile. We see some of the fintechs coming into play. But our strategy is more of the partnership in the business. Rather than seeing the players as competitors, we see these players, as most of them, as partners. And we have forged and signed off a couple of partnership. As you could see, more of the engagement that we look at is to just work together, because the market share is still too big. We are the largest players in the market, but we understand we cannot be everywhere. So in places that we cannot be, we take advantage of the partners. We have been partnering with the telcos on the mobile network. We see a lot of integrations happening. We see again the central bank initiative to move, opening up this market in terms of the interoperability. So more of the competition we see a part of what is seen from outside, but for us, we see it as more of collaboration and the partnership to leverage on the market potential.
Okay, thank you very much for that response. Now let us see some of the questions on the chat room. And Ami, do you have any question or want to continue moderating?
For now, I think I'll leave it to Anna Mwasha with the questions on the chat. Karibu.
Asante. So there was a question in the chat around our cost-to-income ratio, on how it's higher compared to other players in the market, and what our optimal cost-to-income ratio would be, which I think would make a good segue into our outlook session. So Fred, if you could just walk us through the evolution of our cost-to-income ratio over the years, and how this would reflect on our strategy and our new ambitions to be the undisputed leader in the market. Karibu.
Thank you, Anna. We shared our journey as we are closing the 5-year strategy. And remember, we are coming from a 66% cost to income in 2018, 2017. And we are able to bring it down to 49% as we are closing last year. We are able to maintain the same despite of our business growth and expansion strategy. As I highlighted, depends on what one does. We have built a strong foundation in the ground. The number of subsidiaries that we have opened in the new business are quite pronouncing our ability to grow, but is still sustain our operational efficiency. As we shared during the half year, we are still on the phase of implementing of our core banking systems, which again, once completed, and the ones we have seen, particularly relating to the digital channels, you see the growth in terms of the revenue coming from the digital channels. So that explains our capability to grow the revenue, because this is an equation. You either accelerate the growth on the revenue and sustain the cost part. So despite of our business growth and expansion, growing, opening our Congo subsidiary, opening our CRDB insurance subsidiary, opening the foundation, reaching out to the market in terms of our branch, and carrying out our mission critical core banking system projects, where we are still incurring double cost. We are able to close at a cost to income of 49.5. So you see in the outlook, confident that we should be able to deliver better cost to income ratio. So do we take more question or we go to the outlook?
That was the last question. That was the main question in the chat. It was around the CSR. So I think you can walk us through the outlook for the year. And if there's any question, it can be included in the chat, or it can be shared with Orbit and team, and we'll be happy to respond to them at a later stage.
So thank you, Anna. As I had highlighted, you see, we closed the year with the loan growth of 23%. And as we are sharing the numbers during the half year, we highlighted on the trend in terms of what we see in the loan portfolio growth, likely to ease because of the the easing of the post-COVID loan portfolio growth. But again, now after the post-COVID, we'll be growing from the bigger base. So 13 to 18%. Customer deposit, as I highlighted, we have continued to reinforce the value chain. We have grown strong foundation in the base. Our insurance foundation, our CRDB foundation creates our strong base in terms of reaching out to the market that we have not been able to reach. Congo market, again, the new market, just confirmed the growth that we are talking about, 16 to 25 in terms of the deposit growth. Non-funded income, as demonstrated from what you have seen on the digital channel, is expected to grow in the range of 35 to 40, just confirmed by the growth that we just closed with. The cost to income ratio in the range of 43 to 47%. Yes, we understand some of our subsidiary will still not be able to break even in year one, but we are confident that we should be able to see more positive contribution as we move forward. Return on equity and the return on asset, just you could see in the range of return on asset 4.5 to 6.5, and the NPL just maintained within 2.5 to 3.5.
Thank you, Fred. Fortis and Ami, over to you.
Thank you very much, Mr. Nshekanabo, for this splendid outlook. Can you elaborate more on what will be the magic of growing the customer deposit from the 7% to the one you have just indicated, 16 to 25%? What will be, if you can volunteer to share, what magic are you going to use on this area?
When you look at the money supply, you look at the money supply, which is closed at a growth of 14%. And again, we see more business growth, but reaching out of more of the marketing that we have not been reaching. And that is actually confirmed with the base that I have confirmed. The contribution from the subsidiary, our focus on the retail segment, but reinforcing on the corporate confirms that growth, but supported with what we see from the market potential. Last quarter, we saw a bit of slow government spending, but we are confident in 2024 2024, likely to see more of expansion in terms of the government spending, and confident that we should be able to see more of the M3 expansion compared to what we have seen this year.
Thank you, Mr. Shekanabo. I just had a quick one before we move towards the outlook, and I think my question, I don't know, it looks like it will determine the outlook. When your results came out, I was reading through the tabloids, various sources in what the experts are saying. And one of the key highlights was actually applauding the banking sector for making quite huge profits in year 2023. But the question was, at what cost? Because a normal bank user will be complaining about the fees around the banking sector. But when you look at the bank's strategies around increasing non-funded income. So moving forward, how does the bank look towards mitigating, yes, making profits, it being a profit maximizing firm, but also ensuring that the customers also are at least given services which are affordable to them in terms of commissions and fees? Where is the balance moving forward?
It's quite a good answer, and that's where we have been playing. And the question was, how do we balance in terms of profit? And clearly stated in our strategy, we are here to create impact, and focusing on the livelihood of the people we serve. Just not really much as we focus on profitability, because we are in the banking business, which also requires making the profit that are able to sustain the business growth and comply with the regulatory requirements in line with the business or the industry soundness. But yet, if you look at what is happening, the pressure on the NIM just explains it all, much as we continue to make sure that we don't reprice our loan portfolio out of the market, but we will continue to make sure that our credit extension to the private sector are affordable, and just in line with the each segment's needs, and we continue to grow in the markets. Some of the market we don't see some of the players playing. Look at the expansion in agriculture, the areas of women and the youth, the expansion of credit on SME and the MSCs. These are the impact areas, and we are talking of our strategic initiative to make sure that we reach out to the spaces where the rest cannot reach. They might be expensive and they might be a risk, but we are able to reach out this market and be able to deliver returns to the shareholders. Number two, on the non-funded income, mainly the alternative channel. We are looking at the cost to save model to deliver our solution. Our mobile, digital, our internet banking, our agents banking network, where one has to spend 10,000 to reach out to the financial service, it can just access the financial service just on his fingertip and just across the door, across his door through our widely spread agents banking network. So we are confident that our pricing affordable and the cost to save model to our consumers. We continue to make sure that we focus in areas where we can make more impact through our strategic initiative, and we believe we should see more of affordable financial services to various segments and sectors.
Yeah, I think maybe just to add, we're also looking at strategic partnerships on how we can better serve and have some of our partners take on the risk of people that have already invested in some of the areas where we want to play, so that we also don't make the same investments. So I think we're already seeing a number of partnerships, but there'll be a lot more partnerships so that all players can reduce the cost, because it's not a once-off, or it's not a one bank or one MNO is charging, it's costs that apply to all of us. So we're working together and seeing how can we best serve our customers in an affordable manner, and in a way that also makes business sense to us as a commercial entity. So yeah.
All right, thank you. And I think this will be just a question, but you could call the fifth. On the financial markets, of course, investors will just be interested in two things: capital gain and dividend income. Anything on that? Because we have seen, the price has been moving. Now the other question is on the dividend. Any range, any angle to expect?
We have our dividend policy out there. Our payout ratio is 35, in line with the dividend policy, subject to compliance with the regulatory capital requirement. We are confident that we are adequately capitalized, and we are in line with the requirement of the central banks in terms of dividend payment. So just to assure that we work in line with our dividend policy. We are looking forward to announce the dividend for 2023 after the audit of the financials.
So watch this space.
What?
Watch this space. That's what you're saying. Continue. Yeah, watch this space.
All right, great. Asante sana, Anna Mwasha. Thanks a lot, Mr. Shekanabo. So as we are wrapping up, maybe I could just ask for your comment moving forward as a wrap up, maybe as a call to CRDB investors. 2024, what should we expect? And on the financial market side, I think Mr. Fortius will just have a comment on that. Anna Mwasha, Investor Relations, what's your comment to our investors on CRDB? And then Mr. Shekanabo on the banking industry as a whole, and CRDB specifically.
Okay, thank you so much. I think this will be the last time I speak. So thank you for making the time and bringing such a great audience with us. It's such a good turn up. I think we're doing interesting things. As Fred has alluded, we have our new strategy in place that's more outward looking. So it's not so much about us, but really how we can serve our markets. And we already see this picking up in our markets. So more engagement. We have our investor relations page that we update on things that are happening in the bank. We also have a section in our website where this presentation and the rest of the presentations are on, I think, as far as maybe the last 5, 6, 8 years. So you can really see our history and what's happening. But I'm also available, and I'm happy to always take questions and explain really what the drivers are and why we're doing the things that we're doing, and just provide that comfort that we are here to create value for our stakeholders and our shareholders. But more importantly, we are releasing our audited numbers in a couple of weeks, I think in a couple of months. We're also releasing our annual report, which also just gives in-depth analysis of our performance. And we have our AGM coming up. So just watch this space, watch our social media pages for more updates. And of course, thank you, Ami, for answering questions and bringing the questions to us. Thank you for the collaboration. I appreciate it.
Ami, thank you. Just to close, banking sector remains sound, and we see more of positive, and we're optimistic in terms of the future performance in this sector, despite of the global trends and the challenge. But we are confident on the resilience and the support that we are receiving from the regulator, the central bank. Looking forward for another great year in terms of the CRDB performance. We have done great investment in 2023, and 2023 has been first year for our strategy implementation. We have been able to ground the market and our strategy. We are confident that we should be able to deliver in line with our strategy in 2024 and the plans. Just watch out on our performance. I would encourage the investors to take more positive decision on our stock. Looking forward for better performance in 2024.
Asante sana Mr. Shekanabo. Asante sana Anna Mwasha. Mr. Fortius, on the financial markets, what should investors expect?
Okay, thank you very much, Mr. Ami, for moderating this session. And CRDB, Shekanabo, and Anna Mwasha, thank you for showing color behind the numbers. And of course, this detailed presentation will call for further scrutiny by the financial markets. So I expect a lot of questions. Anna Mwasha with investor relations, I'm sure we'll be getting a lot of queries for more clarification or for some color on everything which is will be supporting your business in the sector. So we expect, of course, some of the information you have presented is already reflected on what has been the reaction of the price in the market, but still we should expect some more reaction, given that your audited results, which will give some indication of where the dividend will be, is expected to put some more pressure on the prices. But we hope that you came out to share this information to the financial market, and we should be expecting the financial market to give validation of the numbers you have just presented. So thank you very much for this session, and we hope to see you during future calls. Thank you very much. And Ami, back to you to finish the session.
Okay, thanks, Mr. Fortius. Well, CRDB team, once again, thanks. This is largely appreciated, and we look forward for more sessions like this. On my side, I'll be waiting for the numbers so that we can do the evaluation and do some forecasting and come up with the updated fair value. Mr. Shekanabo. So we will reach out and we'll talk about various issues on that intrinsic value. But for sure, as the performance looks, the bank, the stock itself is undervalued, so there is opportunity. We are still on the discounted angle. So let's see as we move forward. Asanteni sana, nashukuru. And to our listeners, thank you for being around. Thank you for joining us, and we look forward for your participation on future sessions. Niwatakie jioni njema. Have a good evening. Asanteni.
Thank you. Asante sana. Jioni njema.
Thank you.
Asante
all.
sana.
Thank you. Thank you very much.
Thank you.